The one investment you should not own right now. I'm stunned. I'm stunned how I missed this actually, and I'm going to share with you why you should be stunned that you missed it if you own this right now as well. Now, I don't own this. I don't recommend. I don't recommend mutual funds. I don't recommend ETFs. I just say buy the index and be done with it. But this fund is part of Vanguard's core portfolio. I guarantee it's part of a lot of other asset allocation portfolios, and you shouldn't have it. All right. So I was talking to a guy yesterday, and he, hold on a sec, and we're going over his portfolio that he has with Vanguard, and he was sharing his screen, but it's kind of like low. I couldn't really see it very well, and I saw one fund that said 0.18%, which I said, well, that seems for a high. That's on a bond fund. I said that seems pretty high because I thought it was the expense ratio. I said 0.18% for a Vanguard bond ETF. I said that seems high. And then when I looked at it deeper, I said, oh, that's not the expense ratio. That's actually the 30-day SEC yield. I said, it just hit me like a ton of bricks. I said, it's the International Bond Fund. I think it might be ETF. We'll look at them both. I said, that's right. I never put two and two together. That the international market on bonds, on government bonds and highly rated corporate bonds is basically zero. And then if you're buying international bonds, essentially zero interest rate internationally, well, of course, that's going to extrapolate back to the investments in the Vanguard International Bond Fund. I said, why would you own that? It doesn't make sense. So let's dive into this. It just hit me like a ton of bricks. I said, okay, so I've known the EU has basically zero interest rate policy, ZERP, or NERP, negative interest rate policy. I know Japan. But it never occurred to me that the actual international bond fund that invests in these EU and Japanese products would have that too. I never put together. It's nuts. So let's take a look at this. So here's a Vanguard Total International Bond ETF, BNDX. And we're going to go down here. We'll see it has an expense ratio of 8 basis points, quite low. So I said, yeah, I didn't think Vanguard ETF bond would have 18 basis points expense ratio. But check this out. The 30-day SEC yield is 0.21, 21 basis points. All right, now I want to show you this real quick. So remember, expense ratio 0.08, yield 0.21. If we click on the Admiral Share Mutual Fund, all right, so remember, 0.08 expense ratio, yield 0.21. Admiral Share Mutual Fund, we're going to see expense ratio of 0.11, yield 30-day SEC yield 0.18. So essentially what that says is on bond funds is you could not get more proof positive what I've been saying for years. Their fees come out of your yield, if that makes sense. So the higher, and not just, and Vanguard just notoriously cheap, but other people are not. So the higher fee you pay via an expense ratio or a management fee, it has to come out of the yield. There's just no two ways around that. So I hope that made sense. So 3 basis points, remember 1 basis point is 1/100th of 1%. 1% is 100 basis points. So when we say 11 basis points, that is 1/10 of 1% plus 1 basis point, or 11 basis points out of 100 for 1%. Anyway, so what happens here? We have expense ratio of 11, yield of 18. All right, if we go back to the ETF, we have expense ratio of 8 or 0.08. As you can see, 0.08, yield of 0.21. So it's like a seesaw. The higher the expense, the less yield you get. All right, so I want to talk about 30-day SEC yield because my man made a good, he said, is that just monthly? So we times that by 12. The 30-day SEC yield is not times by 12. Is the last payouts over 30 days annualized to give you the 30-day SEC yield. So this is the most up-to-date there is because they're not looking at January's payout and annualizing it today. They're looking literally at the last 30 days of payments that you received owning this fund and annualizing that. So if you read it specifically, I'll show you. A non-money market SEC yield is based on a formula mandated by the SEC that calculates a fund's hypothetical annualized income as a percentage of its assets. The security's income is based on the current market yield to maturity for bonds or projected dividends for stocks of the fund's holding over the previous 30-day period. The hypothetical income will differ at times and sometimes significantly based on actual experience. But anyway, so this is what you're kind of expecting, 0.21. And I said, oh, it totally makes sense. Well, let's go to trading economics. And I said, well, oh, actually, no, I want to go back here real quick. So I want to show you what this, again, the ETF is the same thing for the other fund. We're going to show you what the ETF owns. Oh, lo and behold, 58% in Europe, 24% in Japan. The largest holdings, though, are Japan. So of the 24% Pacific, excuse me. Of the Pacific, Japan is by far and away the largest holding because Japan is the largest holding of this investment. A quarter of the portfolio is in the Pacific. The vast majority of that is going to be in Japan because 17% is in Japan bonds, and Japan is the largest holding for sure of the entirety of this fund, and certainly the predominant, the vast majority of the Pacific bonds that's in there. I hope that makes sense. So you can see Japan, France, Germany, Italy, and the UK. So Japan, France, so we're going to go here. Japan, interest rate negative 1 or negative 10 basis points. Interest rate negative 10 basis points with inflation of negative 90 basis points. Germany, interest rate 0, inflation negative 30 basis points. What we say? Was it Italy in there too? I think we said Italy. Japan, France, Germany, Italy. Okay, Japan, France, Germany. Let's look at France. France is right here. Interest rate 0, inflation rate 0.2. Germany, Italy, 0. So the top 4 holdings of this fund have 0 to negative interest rates. And the Euro area as a whole has 0 interest rates. I mean, just it's stunning to me. It's stunning. I'd never picked that up. UK, I think UK had a positive. Let's see. UK had, 10 basis points. So the top holdings, 5 holdings in this fund had 0 to negative interest rates. And then one had a 10 basis points. Look, and the top 5 holdings are 17, 12, 10, 8, 7. You see what I'm saying? There's no there, man. They even have some U.S., by the way, which is weird because this is the international bond, and I don't get that. But anyway, why would you own that? It doesn't make sense. You're not making any money. Now, you are taking a risk. The risk is here is the duration. So let me explain what duration means. For every 1% increase in interest rates, the price or the NAV, the net asset value, drops by the duration. So if we had a quick 1% increase in interest rates, the price of this fund would drop by 8.5%. All right, hope that makes sense. You're getting compensated. You're only getting less than a quarter of 1% to have a risk of 1% increase in interest rates to have your portfolio decline by 8.5. If now a 2% increase in interest rates, your portfolio would decline by 17. Now, some would make the argument, well, we could have a negative interest. We could have interest rates go down. In that case, the portfolio would go up in value. That is true. Are they going down when they're already at 0? I mean, again, negative interest rate policy, while interesting, isn't necessarily something that has been bought into lock, stock, and barrel. I mean, there is negative interest rates. I get that, but to go down 100 basis points, not likely. So, and I don't even think the interest rates are going up, but what I'm saying is you're taking significant risk. You're getting an 8.5 duration for 0.21% on your yield. There's no, why take that risk? Let's just read the duration here. A measure of the sensitivity of the bond and mutual fund prices to interest rates movements. For example, if a bond has a duration of 2, this price would fall 2% when interest rates rose by 1 percentage points. On the other hand, prices would rise by 2% when interest rates fell. Now, duration here at 8.5, the prices will drop by 8.5% when interest rates go up by 1. That's a whole lot more likely than go down by 1. It doesn't matter because at the end of the day, I don't have my thing. The bond market is fixed. I mean, we know exactly what your rate of return on the bonds are going to be. Let me show you here real quick. So bonds is very easy. What you see here is you have an issue right over here, an issue of $1,000 bond, and that's the par value. All right, that's the issue. And then it matures in 5 years for $1,000. So it matures in 5 years for $1,000. That is the par value. In the interim, you get 3% as a coupon. You're getting that each and every year. In this case, we're 1, 2, 3, 4, 5. So you're getting $30 a year. That's it. So we know for a fact this bond only has 2 things that can happen. It can give you 3% a year or $30 a year for 5 years. So the issuer of the bond knows it's a fixed income. They know exactly what their obligations are. Their obligations are to pay you $30 a year for 5 years, and then at maturity to pay you the par value, $1,000. That's it. So the issuer of the debt knows exactly what their liabilities are. That's it. $1,150 all said and done. There's no more, no less. That bond only has one other thing you can do other than be issued at mature at par and pay the coupon. It can go bankrupt. That's it. So there's only two places for a bond to go. It can mature at par. It can't go above at maturity. It cannot go above maturity at par. It can't go above par at maturity, excuse me. So we know for a fact a bond cannot do this. So it cannot go up. It can't, because it has to mature here. This is a par. It has to mature there. There's just no two ways around that. Now it has a call, which means it could be matured earlier if it has a call, but we're not even talking calls. We know for a fact this cannot happen, because at maturity it's going to come to $1,000. I mean, just think about it from a debt issuer's perspective, if you would. They're issuing a bond. They're borrowing $1,000 from you, and they're going to pay you back $1,000 at a certain time. That's it. That's how it works. There's no other way around that. In the interim, they're going to pay an interest rate for the privilege of using your money. Now, the other thing that could happen is it could go kaput. It could go to zero. All right, so it could go bankrupt. A government bond can't, but this one can. It can't go above par at maturity, but it could go below. It could go bankrupt. That's it. There's only two things for a bond to do. There's no other way. There's nothing else it can do. Now, in the interim, could it go up? Yes, but it's always going to mature at par. So we always know for a fact what the end result of a bond is going to be. Now, man, Pablo, you stink. And so here you're taking on price volatility risk. Now, these aren't going to go bankrupt, but it still can have volatility on the price of 8.5 as a duration, and you're only getting rewarded 21 basis points. What's the point of doing that? Don't do that. So it literally makes no sense. So what you should do instead, let's just look at old-fashioned Ginnie Mae, BFIIX. This is what I would do instead if I'm an American. If I'm not in America, I still do it, but I don't know your circumstance. Just buy the Ginnie Mae. Buy the Ginnie Mae. Here, notice, you're getting 1.25 is your yield. That's a 30-day SEC yield. So you're getting, I don't know, whatever that is. That's 5 times, 6 times what the other bond was doing. And you're getting less risk. Well, because it's all U.S. government debt. There's no foreign bonds here whatsoever. All the good old-fashioned U.S. government, all right? Now, you don't really have to worry so much about duration on Ginnie Mae because it's mortgage-backed securities. Literally, if you own Ginnie Mae, you own my house because I borrowed for this mortgage from Penn Fed, issued through the Veterans Administration, who's guaranteed by Ginnie Mae. So you, as a Ginnie Mae investor, are guaranteeing the VA loans for which I use. But be as it may, there's not much risk in the Ginnie Mae in terms of price volatility. You can see the duration is 1.9, and it's U.S. government debt. So it's completely the most safest investment there is. So what do we see here? We have a higher yield. We have lower risk. And it's actually probably even more liquid in that regard because foreign governments aren't involved. So there's no sense at all to own the international bonds. Now, I want to show you something else. So this is 2016. I'm sure it's still roughly the same. And here's the Vanguard asset allocation models. 0 to 50, we'll just use the bonds are in blue. And you can see international bond, 30% of an income portfolio, 26% of a 1090. So 50 is 14.7% of a 50-50 portfolio. What's the point, man? I don't get the point at all of having any international debt. It makes no sense. There's no value added. And people say, well, it gives us diversification. Diversification for the sake of diversification doesn't mean anything. You want to diversify because there's a reason to level off the volatility of certain shares. Like you have some domestic stocks, you might want to diversify with international because international hasn't done as well. You have some growth stocks, you might want to diversify for value because value hasn't done as well. And here, there's no upside on owning international bonds, none whatsoever. I'm trying to think what it possibly could be. There's literally no upside to international bonds. There's only downside, and if there is no downside in terms of volatility, you're only getting 21 basis points. It makes no sense, and it doesn't offset necessarily. It won't offset volatility on your own portfolio if you have domestically leaning stocks and bonds, because Ginnie Mae will even reduce that volatility with higher yields. So look, you got to do whatever you want, but this is the one investment that people should not own right now. Love your comments. We'll see ya.